To order, members, pursuant to Standing Order 1082, subject matter of Bill C-15, an act to implement certain provisions of the budget tabled in Parliament on March 22, 2016, and other measures. And I do thank the witnesses for coming. Before we start, I'm going to table the subcommittee on agenda. It is before you. Do you want me to read through it? The subcommittee on agenda met on Monday to consider the business of the committee and agreed to make the following recommendations. Do I need to read it, or are we okay? Dispense. Somebody want to move that? Moved by Ms. O'Connell. All those in favour? Opposed? Carried. Then.
Order, Mr. Chair. I believe there's a motion not dealt with in the subcommittee report. L'avis de motion a été fait le 22.
The notice of motion was done on the 22nd of April, and it is in relation to the right of participation of independent MPs, and I would like for this motion to be put forward at this time.
Want to read it, or is everybody clear on the motion? Do you want it read? Okay, Mr. O'Doudif wants it read. Go ahead.
Que relativement aux ordres.
That relative to the orders received from the House that dealing with this aspect, that the committee proceed with the issue raised that is not submitted to the committee, dealing with the present amendments, dealing with the bill sent from the House, such that the House should study it. B, that the amendments under paragraph 1, 48 hours before a article by article studying of the act, that this be looked at as long as the committee can amend that time frame regarding the bill. And C, that in the article by article study of the bill, that the person who has put forward those amendments should be allowed to make brief observations to support them.
It's been moved. Any discussion? Mr. Caron.
Oui, je vais m'opposer à la motion pour.
I'm against the motion for two main reasons. First of all, that we, on the government side, we expected that we act differently relating to the procedures. We see it's the same thing. It is a motion that it takes up what the previous government was going to do, and this is problematic because what is proposed by the government does not allow for a proper assessment of the amendments. If people are putting forward amendments, then they explain those amendments in 1 minute or less, and a debate takes place without them, as does the vote. And so I think that this goes against the intent of Parliament, and it goes against the role of members of Parliament at the House. And it's really an expedited approach for the government. And this should allow for independent members to table amendments in the House, and this would be a disincentive for the government to present omnibus bills. And of course, if there are a lot of amendments that are proposed, and this was the case one time in the previous legislature, well, it's probably because there are certain sections that are proposed in a bill. So we're reducing the number of sections and the number of amendments that are put before the House. And so I think this is a way for the government to remove the voice of independent members in the House. And so that's why I'm going to vote against it.
Question? All those in favour of the motion put by Mr. McKinnon? Opposed? Motion's carried. Then on to the agenda for today. Just for committee members, we will go in camera following the witnesses to deal with the witnesses before committee. We talked about it a little bit yesterday at the subcommittee. And as well, I would say to the witnesses, and I think Mr. Caron is going to bring this point up as well, because the The bill has not been passed the House officially as a bill to committee. The department has been unable to give us the briefing binder they normally do, and so we don't have advantage of that information, and so we will reserve the right to call departmental officials before the committee again if members so wish when we get that briefing binder. Mr. Caron.
Avant que je ne parle sur cette question,
Before I deal with this issue, I would like to ask whether the motion that was put forward by Mr. Dussault at the last meeting, because I believe it was not part of the subcommittee's report because there was a possibility of an amendment on the Liberal side, if I remember correctly. So do we have time at the end of today's meeting to discuss affairs relating from the subcommittee? Yes, it's not an in-camera. No, it's rather under affairs of the committee. And so based on what you said, I sat on this committee for a 3-year period and never did we have a meeting with officials at the beginning of a discussion of a bill without having the briefing notes. This is tremendously important because there are aspects that are not in the bill, and therefore the briefing note or the technical briefing allows us to complete the information. So I feel that as a MP, I am not able to ask the appropriate questions and to ask questions about technical issues in depth without having access to the briefing document. If I understand correctly, it's the department that doesn't want to provide this in advance because the bill hasn't gone to second reading. But that's not our fault because if we are studying this as a committee, it's not our fault that it hasn't gone to second reading. That was the choice of the majority of MPs. But I have problems in terms of being efficient to study this with officials, even if we can ask them to come here. And there are the issues relating to procedure and that fall under the responsibility of the government. Mr. Champagne. For the record and for my colleague, we have to remember that we had a session that went from 7 p.m. to midnight, whereby all the officials to whom the clause is applied and was related to the expertise. We can tell you that they answered all the questions, and they answered those questions for 5 hours from 7 until midnight, and they answered all the questions that MPs wanted to ask, as well as the personnel of the MP. I know that there are members of the NDP who stayed until the end. They were able to ask technical questions relating to all the measures in the Act and the bill before us, and so I understand what Mr. Caron is saying, but you have to be aware that there was an information session that lasted longer than 5 hours that dealt with the technical aspects and not just the substance of the bill, but all the amendments. And so I think that we have to keep that in mind. Documents were made available. Answers have been provided over a 5-hour period for those people who attended that meeting. Mr. Caron.
deux arguments par rapport à cette réplique.
Two comments in relation to that answer and why I think it's inadequate. The technical briefing was in camera, and this is a public session, so these are two different things. And the second aspect is that the technical briefing that we had was held in the evening on the very same day as the bill being tabled in the House. And so it is a bill of 179 pages with 238 clauses. And so we have a vision of that bill after we've studied it for a few days relative to how one have studied it after a few hours of receiving it and after hearing the technical briefing. I know that the officials were professional in providing that technical briefing, but we can't compare the two situations. So here we have a recorded session with a transcript, and there are aspects of the bill that might have been problematic in the technical briefing, and now there are two different aspects here.
Discussion here, if we can help it, members, we need to get to the questions if we can. Mr.
Juste répliquer à mon collègue pour dire.
I would just like to say to my colleague that I find this rather surprising, these comments that are being made, because among the people who were there,
Yeah, I just have to say that, having attended the technical briefing, I thought it was a wonderful moment because we could actually have a lot more freedom in order to ask a lot of questions about various subjects that we're not experts in, and to really get to the depth of what's in it and to try and gain that greater understanding. So, I think this actually might be more constraining than actually the technical briefing itself. But anyways, I thank the officials for coming.
Okay, could we move on? There was just one point that I neglected to mention in our subcommittee report. When we discussed it yesterday, we weren't sure if the minister was going to be doing the committee of the whole the same day as as he was before committee. I understand he is going to be doing the committee of the whole on the May 30th. Therefore, that meeting will only go till 5:30 on that night. Just so we're clear, because the subcommittee report isn't. Okay, starting with the officials, there was a number of points raised by members that they wanted a briefing on. And we'll start with Part 1, amendments to the Income Tax Act and to related legislation. So I'm not sure who is leading the pack, Mr. Demeter, Mr. McGowan, Mr. Green, and Mr. LeBlanc.
Would you like a short overview of the part? Okay.
Yep.
So Part 1 implements certain income tax measures that were proposed in the March 22nd, 2016 federal budget. I'll go through each in order as I'm aware of the time constraints. It would eliminate the education and textbook tax credits, exempting from taxable income amounts received as rate assistance under the Ontario Electricity Support Program. It would maintain the small business tax rate at 10.5% for the 2016 and subsequent taxation years, and make consequential amendments to the dividend gross-up factor and dividend tax credit rates. It would increase the maximum deduction available under the Northern Residence Deduction, as well as eliminate the Children's Arts Tax Credit and eliminate the Family Tax Cut Credit. It would replace the Canada Child Tax Benefit and Universal Child Care Benefit with the new Canada Child Benefit. It would eliminate the Children's Fitness Tax Credit and introduce a new School Supplies Tax Credit. It would extend for 1 year the Mineral Exploration Tax Credit. It would restore the labor-sponsored venture capital corporations tax credit for purchases of shares of provincially registered labor-sponsored venture capital corporations for the 2016 and subsequent taxation years. And it would also introduce changes consequential to the introduction of the new 33% top individual tax rate that's in Bill C2 currently. Part 1 also implements other income tax measures that were announced by the previous government but had not been enacted. And these were the current government's intention to proceed with these was announced as well in the March 22nd, 2016 budget. These include amendments to an anti-avoidance rule in the Income Tax Act that prevents the conversion of capital gains into tax-deductible intercorporate dividends, measure qualifying certain costs associated with undertaking environmental studies and community consultations as Canadian exploration expenses, rules ensuring that profits from the insurance of Canadian risks remain taxable in Canada, amendments ensuring that the dividend rental arrangement rules under the Income Tax Act apply where there's a synthetic equity arrangement in place, rules providing specific tax rules in respect to the commercialization of the Canadian Wheat Board, mainly including a tax deferral for eligible farmers, measure permitting registered charities and registered Canadian amateur athletic associations to hold limited partnership interests, rules providing an exemption to the withholding tax requirements for payments by qualifying non-resident employers to qualifying non-resident employees, rules limiting the circumstances in which the repeat failure to report income penalty will apply, amendments permitting the sharing of taxpayer information within the Canada Revenue Agency to facilitate the collection of certain non-tax debts, and lastly, amendments permitting the sharing of taxpayer information with the Office of the Chief Actuary.
So, do any members have any questions on those sections? On part one, we'll go through each section. So, Ms. Raitt.
Sure. Thank you very much. I'm wondering if an analysis was done by the department on the effect for a family where the children would be eligible for fitness credits, arts credits, and tuition credits in the family tax cut, and what the total cost would be to a family that fit that description, offsetting it with the child care benefit.
Pierre?
Okay. I think what we can say there is there is a stat that so 9 out of 10 families will be better off under the Canada Child Benefit than under the current system of benefits. If you were to take other measures, both the middle class tax cut that was introduced on December 7th in C2, the elimination of income splitting for families with at least one child, and the elimination of the children's fitness tax credit and the children's arts tax credit. If you took all those measures together, you'd still, one piece of analysis we did do is that you'd still have about 9 out of 10 families that would be better off. So it's once you take, it's the net of all those measures.
Are you able, can you provide that for the committee to see?
Yeah, we can follow up.
That'd be great.
Yeah, just that.
Thank you very much. Because as you know, in the budget, it says specifically in the examples that are given on page 63 that education tax credit, book tax credit, income splitting, children's fitness tax credit, and child arts tax credit are not included in those examples. And I'm looking for the more holistic effect on families.
So, okay.
Because my one more thing.
Will be provided. Go ahead.
Yes.
That's okay. And I just wanted to let you know that right now in my riding, since it's tax time, I'm getting a lot of calls from constituents trying to understand specifically what it's looking for them for next year, and we're not able to provide them with that analysis. So if you can give us some comfort, I think as members of Parliament we would feel a lot better than saying 9 out of 10 families, because everyone wants to know if they're the 1 out of 10 who doesn't do better. So that would be very helpful for us as well. Thank you very much. I had another question. In the calculator that's provided for child care benefit, if you plug in a certain number, you're able to see what the benefit is going to be for the family. I was wondering whether or not in the calculation of income that will be used as the means test, would that include all sources of income, including social assistance or any other monies that are actually provided?
Sure. So if you look at current child benefits, so say the Canada Child Benefit, tax benefit, or the new proposed Canada Child Benefit, what the Canada Revenue Agency uses to calculate entitlement, it's a measure of income known as adjusted family net income. And here's how, basically, if you think of your tax form, it's all the different sources of income that you include when you arrive at total income, earnings, investment income, social assistance in that case, that would be included. Then you take away certain deductions. Examples of those deductions would be contributions to registered pension plans, contributions to registered retirement savings plans, child care expenses, union dues. So, and you arrive at something. There's also an adjustment since the universal child care benefit is currently being paid. That's also taken out, and you arrive at a measure known as adjusted family net income. And that's what's used currently for child benefits, and that's what will continue to be used for calculating entitlement to the new Canada Child Benefit.
Yeah. One last question, a bit technical but very important. What will be the effect on well, first of all, in the child care benefit, will it be taken into the calculation under the Canada federal guidelines with respect to payments of support from one family member to another family member? And the example is this. Right now, in a lot of cases of joint and shared custody, you'll have one salary of one individual taken, the other salary is taken, and you do a set-off. One parent pays so much to one, the other parent pays to the other. Will this amount, in the hands of the parent that qualifies, will that be added into the income, thereby decreasing the level of support payment that needs to be paid from one support member to the other?
I don't know. It's the Department of Justice that looks after the calculation of the child support guidelines, so.
And from a technical point of view, will the child care benefit, although it's not taxable, will it be considered income, and will that income be grossed up for the purposes of determining what the true level of income is for the parent?
Yeah, for the purpose of the child support, I don't know.
Well,
Wonder,
who can
I
tell us that?
wonder
'Cause I think it's
if
relevant.
we can somehow find out. We all deal with that issue in our constituency offices
Absolutely,
for sure.
Wayne. This is the real deal
they
here.
They come to our offices over concerns and that. So if you could just get back to the clerk and who we could call to answer that question, we would do that.
And I'll tell you why,
do that.
so that you guys understand what we're talking about. If you have a zero income, you're going to receive a certain amount of child support. If you receive this child care benefit on a grossed up basis, the maximum amount is a $24,000 salary. That's what it becomes. Therefore, of course, there's going to be an adjustment to child support payments that are made from one parent to another. This is a valid concern. A lot of Canadians are divorced. A lot of Canadians have settlement agreements that are going to be severely affected by this one single change. $100 a month doesn't really change things. $6,000 a month grossed up to $12,000, $24,000 a year, it actually does. So we should really know the answer to the question.
Okay, we'll try and find some answers on that. On my list, I have Mr. Caron, Mr. McKinnon, Mr. Coleman, Ms. O'Connell, and Mr. Robluta. Mr. Caron.
Oui, je vais avoir quelques questions.
Yes, I have a few questions, but first of all, I'd like to thank the officials for being here today, and not only you, but those people who will come up after you. But of course, the briefing, even in the time frame that it was provided, it was very interesting and useful, but it leads to a whole series of other questions. I'm not going to ask you to comment what I'm going to state here, but on our side, we believe that we have another omnibus bill before us, despite what the government is denying. It is an omnibus bill, and if we look at the bill with 179 pages, which amends 35 acts, that's dealing with 9 different departments. That is a bill that includes a bill that had already been tabled by the government, C12, that was included in C15, and that abrogates retroactively a previous act on balancing the budget. And when I'm talking about retroactively, the government would be violating this act as of the 1st of June. And it's also amending the act to ensure that it didn't really exist, even if they're violating it. And this goes against the rule of law. And it also includes other elements that are important, and I'll have the opportunity to come back to it when we talk about recapitalization of banks. We have a huge number of officials who have talked about various subjects. Bill C-12, when it was tabled, it was quite clear that it was going to deal with the Veterans Affairs Committee, and now it's the Finance Committee that's going to be dealing with it. So it's a clear demonstration that just because something was mentioned in the budget, that it is something that is going to be studied, but it has to be studied by the relevant committees. And C12 is an example of that. So here I'm ready to table an amendment. I would be able to table it at the end, and I would avoid reading it because it's quite long, but I'd like to indicate that this motion would like to send back C15 to the House of Commons to deal with issues of indemnities and compensation of the veterans and members of the Canadian Armed Forces, and that we talk about the recapitalization of banks, the old age pension, and that the Employment Act should be looked at by the respective committees. So I'm not going to read it in detail, but we could talk about that in the business of the committee later on. In terms of the questions.
Partie 1.
Okay.
Yes, in relation to part 1. So I had mentioned this concern during the technical briefing, and I'd like to have your view publicly as to when we talk about the exchange of information between the CRA and the present head of it. The Privacy Commissioner, I was wondering if she was consulted when these provisions were looked at in order to ensure that the CRA is able to have that information in order to carry out their actuarial calculations. And if those discussions did take place, did they take place also since the technical briefing?
There are actually two measures in the bill dealing with information sharing. I'll deal with both so as to, and try not to confuse them. There's information dealing with the, within information sharing within the Canada Revenue Agency for the sharing of information to support the collection of non-tax debts. For that measure, the Privacy Commissioner was consulted, but we were told that they do not provide advanced opinions on whether or not a particular amendment would contravene the privacy rules, but instead agreed to continue working with the Canada Revenue Agency to ensure that all of the privacy guidelines are followed and that taxpayers' personal information is adequately protected. Then in the second case, there's the information sharing with the chief actuary. The Privacy Commissioner's policy in that case is the same, that they would continue to work with, or that they would work with the Canada Revenue Agency in ensuring that in the administration of the program that taxpayers' privacy rights are protected.
Donc, ce que vous me dites, c'est que vous n'avez pas consulté.
So what you're telling me is that you didn't consult with the commissioner, but you followed the policies or the guidelines that have been established by the commissioner or by the office of the commissioner.
Administration of the program. I mean, the information sharing hasn't passed, of course, and my understanding is that it won't be shared until royal assent, and so the guidelines of the Privacy Commissioner in sharing information, it won't have come into effect because they haven't started yet. But once the sharing of taxpayer information commences, then the Office of the Privacy Commissioner would be working with the Canada Revenue Agency to ensure that the appropriate safeguards are not only in place but followed.
Oui, encore une.
More?
One more, if you don't mind. En ce qui est trait.
As far as the issue for the employees' pensions funds in the capital risk areas, there is a distinction to be made between the provincial funds such as the FTQ and those of the CSN and those that fall under the federal regime. Why is the distinction there? Because in one case we're trying to establish credit to 15%, and in other cases it's going to go down to 0. And so why is there a difference in the difference between these labor-sponsored venture capital corporations tax credit, and what impact will that have relative to those people who are impacted by those funds? As far as your first question is concerned, well, the difference is if we're looking at the labor-sponsored funds, they fall under provincial regimes and provincial schemes. So these funds are registered under a provincial law, and it is the provincial government that provides a tax credit for those funds. And here we're talking about assets of about 96% of assets are linked to funds that fall under provincial scheme. But if we look at tax credits that have been paid to individuals in 2013, for provincial funds, we're talking about 99% of those funds. And so the federal schemes are very small, especially when we're talking about those funds, because there was an Ontario Labour Fund program that existed until 2000, and then Ontario decided to eliminate it, and so there is no provincial regime in Ontario. And so these funds have a few assets, but they fall under the federal regime, or equivalent to those under the federal regime. And so the tax credit will not be reestablished to 15% for 2016. It's only for the large funds that fall under the provincial scheme. But I wondered, why was this difference made? Because this difference didn't exist beforehand. Answer. Well, I think the reason why there was a difference made was to look at those funds that fall under our provincial jurisdiction, and so it was an indication that the provincial government was supporting those funds by providing a tax credit, and were showing that they were interested in investing in those programs, whether it be in Quebec or Saskatchewan. But when one talks about those that are federal funds, there is no tax credit at the provincial level for those federal funds. And so there is no investment at that level. So I think that's one of the main reasons of which explains the difference and why there is an indication of reestablishing the tax credit to 15% for the provincial funds.
Monsieur le Président, et merci.
Thank you, Mr. Chair, and thank you to those people from the Department of Finance who are here today. Thank you for your time and for sharing your expertise with us. My first question is in relation to the Canada Child Benefit. And it's my understanding that the Canada Child Benefit will be excluded from the taxable income at the federal level and in all provinces and territories. Is that correct? Yes, you are right. If we're talking about the calculation of those amounts based on tax and revenue, well, those benefits will be excluded for those calculations. Here we're talking about taxable income. Yes, those benefits will not be taxable, neither at the provincial level. So if we're talking about outside of Quebec, because we know the tax base for individuals is established by the federal government for all the other provinces. And so, in fact, those benefits will not be taxable in those provinces. And as far as I know, that would be the same treatment for Quebec families as well. As far as you know, yes. So you're not sure? Well, what we can say is that those amounts are not taxable for the Canada Child Benefit. They are not taxable. And so I believe that the other government would have the same treatment. You would imagine that? So, well, we can confirm that. Well, this is an important question for my electorate, and so I would like to have an answer as quickly as possible.
Point. Do you have anything further in part one?
Oui, dans le même ordre d'idée.
In the same vein, my question is dealing with the one that Ms. Raitt raised relating to families and children who have a part of a joint custody or sole custody in the case of where parents are divorced, and the calculation relating to that. And so I'd like for those rules to be clarified. The previous Canada Child Benefit, which was the universal child benefit, both in the provinces and Quebec, that applied then at that point? Yes. So here we're talking about a gross up and a gross up to that when we talk about the vast majority of Canadian families. Answer. Well, if we look at the benefits for families, 9 out of 10 families will receive more. Yes, that's correct. And here you're talking about savings or the exclusion of the taxing of that income and the gross amount of the benefit that's going to be provided. Answer, this calculation will be looked at differently or in the same way as the universal benefit at the federal and the provincial level. Well, we look forward to having an answer to that question. My second question applies to Section 18, or the item K, what we're talking about, the mineral exploration tax credit for flow-through share investors. And we know that this tax credit is extended year after year. Am I correct in assuming that?
The mineral exploration tax credit was first introduced in 2000 for a 3-year period, I think, and when it came to the end of that period, it was extended and has been essentially extended on an annual basis, with one exception, a brief period in 2006 when it was allowed to expire, but it was reinstated and has subsequently been extended annually since that time.
Donc, pourquoi on choisit de prolonger?
So why do they decide to extend this on an annual basis relative to this tax credit specifically?
I'm not sure that I can speak to the motivations of different governments over time, but I can say that the tax credit is designed as essentially additional or extraordinary support that's provided to the mining sector that supplements the ongoing permanent support that's available through flow-through shares to finance their exploration spending. The credit is an additional deduction. It's kind of it's an additional credit on top of the deduction that investors receive from a mining company, and I think the governments over time have wanted to I think have the opportunity to review current conditions in the sector and determine if they are appropriate, if it merits extending this supplementary support.
Vous comprendrez que depuis
You'll understand that since 2000 or 2006, the mining sector has gone through almost the entire cycle of highs and lows relating to commodities. And so that's why I'm interested as to know why. And of course, we are in a period where we would like to encourage mining exploration throughout the country. And of course, that would explain why this year it would be logical to extend this. But having gone through the ups and downs of the mining cycle, I'm questioning the logic of this. Should we review it? Should we think about extending the credit for several years in order to provide certainty to investors? And that's why I'm raising that issue as to the relevancy of extending this year after year.
I would just add, Mr. Chairman, for the honourable member, that while the credit is extended for a 1-year period, the credit has a feature called a look-back rule, and that allows a company, when it issues shares in 1 year, it has until the end of the following calendar year to expend those funds. So it allows a fairly lengthy period of planning, and so this year's credit, will support exploration spending, into the following year, and I think, for that reason, it involves kind of a pair of binoculars to gauge how long that support will continue to be merited in the future. But obviously, that's a possibility, an extension on a different basis.
Okay, Mr. McColman, part one.
And thank you for coming today. My questions have to do with in the presentation booklet that you described as the top marginal tax rate. And I want to go to the bullet point that says amend the recovery tax rule for qualified disability trusts to refer to the new 33% tax rate. Now, my understanding is the new tax rate applies to personal income over $200,000. You get hit with additional taxation. But I don't understand this. So if you could relate an answer to me in a real-life example of a trust being set up for a disabled child within a family, and that trust then, as the disabled person becomes independent, perhaps the parents pass away and the trust is flowing money out to to sustain the disabled person in a whatever environment that the money was set up to do. Is this now topped up in terms of having to pay more tax at the 33% rate?
Well, the general rule for trusts is they're subject to taxation at the top marginal rate on all of their income. Really the two exceptions to that rule are qualified disability trusts and graduated rate estates that arise when an individual dies. For qualified disability trusts, as you pointed out, the policy is that these are trusts that are set up to support a disabled individual, and they are therefore provided access to the graduated rates and not the top rate of tax, 29% last year, and then under Bill C2 that would be 33%. And so the access of a qualified disability trust to the top marginal or to the graduated rates is predicated on the income of the trust being paid to an eligible beneficiary, someone eligible for the disability tax credit. And if ultimately there has been income accumulating in the trust that's been taxed at these lower rates, and income is later on paid to someone who would not be entitled in order for it to continue as a qualified disability trust, then the rules have what is called the clawback of the graduated rates, which essentially provides an additional tax in respect of the lower rate previous years, where an amount has been paid out ultimately to a non-qualifying individual. And this would prevent, for example, a qualified disability trust from being set up notionally in support of someone who is eligible for the qualifying, who is actually disabled and would normally qualify, but then after earning income in the trust for a number of years and taking advantage of the lower graduated rates, ultimately the money is paid out to just someone else, perhaps the settlor of the trust or whomever who doesn't qualify. And so that's the policy underlying the QDT, Qualified Disability Trust recovery rules. And that's why with the amendments that are consequential to the introduction of a new top marginal rate, that follows. It's just the existing rules reference the top marginal rate, the previous one of 29%, and the new rules would reference or be built upon the new top marginal rate. So that policy actually remains consistent.
Okay, so I'll take from that in my layman's terms that if you have a trust set up for a child today and that trust begins to pay out, there will be no change for the family in terms of the taxation or the individual, as long as that individual is receiving it out of the trust. However, if that individual becomes deceased and the trust has to be wound up in an estate, then there's some additional taxation that's going to happen to whoever the recipients of the estate are. Am I correct in assuming that?
Yeah, that's correct, but I would just add that provided that the beneficiary to the trust is a qualified, that the trust qualifies as a QDT, as a qualified disability trust, then yes, that is, as long as it's going out to the beneficiary that it was intended, and that beneficiary has a disability that qualifies the beneficiary, and the trust has a qualified disability trust, there should be no change from this this particular amendment to move the top rate in the recovery tax to 33%.
Okay. Still not 100% clear. Perhaps, if I might ask you to best way for most people who are in the situation of having set up trusts for their disabled children and would like to know the consequences of this tax increase that it may have on their families, even when the beneficiary who is disabled stops receiving it because they're deceased, what happens in the case of the rest of the family members who are left to close things up on terms of that trust. So I'd like more clarification, if you could, with real examples from you as to how a typical average family who set up these trusts, and there are many of them across this country, how this tax treatment changes for them. And I'll move on because I know we're limited in time. So if you could provide that through you, Mr. Chair, I'd really appreciate that. Maybe 2 or 3 examples if there's something, if there's variables in there that I haven't hit on. Secondly, in the same section of the notes we were given, it talks about the charitable donation tax credits in Bill C2, and this is where the government has moved to take away the ability that was previously put in the act, or previously put in for persons with real estate and such, giving those to charity, and I'm not totally understanding the description you've given me here. So again, in a situation where there's a person who bequeaths to a charity assets in real estate that were previously, the previous government put into place rules regarding that they could do that without taxation. Now there's going to be taxation on those, or they're going to be that whole provision is going to be removed. Is this what this speaks to?
No, they're separate measures. This is actually more closely related and is a purely consequential amendment to the introduction of the new top marginal rate. The amendments, the proposed amendments that you mentioned that were announced in Budget 2015, dealing with the donation of proceeds from the sale of real property or private company shares to a charity. Those were announced in Budget 2015. They were to have become effective in 2017, and they've not been included in a bill, and they were never enacted. And in Budget 2016, the government announced its intention to not proceed with those proposed amendments, and so the proposals in Bill C-15 are unrelated to those. What they do relate to is as I said, further consequential refinements to the charitable donation tax credit that follow from the introduction of a new top marginal rate. Individuals can obtain a charitable donation tax credit in respect of their gifts. It's currently, and this is not proposed to be changed, on the first $200 of gifts, it's 15%. Previously, and previous to Bill C2 and this, it's 29% on gifts in excess of that. Bill C2, when it was announced, those sets of proposed amendments provided back in December a set of rules that would say that to the extent that you're an individual and you have income in the top marginal bracket, so it's now taxed federally at 33%, instead of the 29% credit, which effectively, given the old rates, gave you a deduction. But for people who are taxed at lower rates, it provided an incentive. For people who have income in the top marginal bracket and that is subject to the top 33% rate, The C2 amendments would provide a 33% tax credit. This, following up upon the government's announcement when those amendments that are in Bill C2 were announced, provided further refinements to that policy, specifically for trusts, which, as I mentioned before, most trusts are actually subject to flat taxation, so all of their income is taxable at the top marginal rates. And so what these amendments would do is, and in fact replace what is in C2, what these amendments would do is provide that if you have a trust that is subject to top flat rate taxation, then it can access the new 33% tax credit to offset its income that's taxed at the top rate. So it doesn't have to be income in excess of $200,000 because their first dollar of tax is taxed at 33%. So it ensures that trusts have the same incentive to donate as high-income natural individuals. And secondly, it provides that in situations where if you have a trust that's taxation year can straddle the end of 2015, so it starts in 2015 and ends in 2016, and it for that year can be subject to the that might be the case for a graduated rate estate where an individual dies mid-year, and it can be subject to the top marginal rate of 33% on its income for the year. This would provide that gifts made before 2016, so in the first part of that taxation year that straddles the year end, can qualify for the new higher 33% tax credit as well, so that they get an effective deduction against their income taxes for those gifts.
Okay, thank you. Thank you, Mr. Chair.
Ms. O'Connell, then Mr. Obutev, Mr. Greywall, and Mr. Caron. Ms. O'Connell.
Thank you. I only have a couple of questions that are relatively short, Mr. Chair. In regards to things like the arts tax credit, income splitting, things like this. So I'll talk about the arts tax credit first. This tax credit, or the fitness tax credit, is only applicable if the family can actually afford the arts program or the sports program in the first place. And then they, as the old system, as they would then in their taxes submit that and they get an up to amount. But families who couldn't actually afford the arts program or sports program in the first place don't get any money under the old program. Whereas the new child benefit, you get an amount based on your income and you can do what you wish with it. Am I understanding that correctly?
Well, I think what we can say is that for both the children's fitness tax credit and the children's arts tax credit, they're based on your eligible expenses, so they are based on what you pay.
Thank you. I know for me, in my riding, the cost of hockey is enormous, and so a lot of families can actually, they don't take advantage of this because they can't afford the program in the first place. So this is why I know why the government is changing this program, but certainly why in my community, for example, it makes a big difference. And in terms of the income splitting credit, again, a single mother would have no access to the income splitting benefits because there's no income to split, or a couple that perhaps could benefit from splitting their income, but unless they have a child under the age of 18. So this is really, it's really excluding a lot of people, and now the money is being spent to give more for those with children. But am I correct that a single mother couldn't take advantage of the tax reductions that come from income splitting?
Yes, you're absolutely correct that the income splitting for families with children under 18, a single parent would not be able to utilize the credit. And as you also noted, it also requires a child under the age of 18 in order to qualify.
Thank you. And Mr. Chair, just one final question, and you may not have this answer, but do you know the average age of young Canadians still living at home? Like in terms of, it's my understanding that young people are living at home longer, so this age of 18 is really not necessarily relative? Again, I don't know if you have that answer, but if you do, I'd appreciate it.
I have no idea.
Okay.
I'm sorry.
That's okay. I'll find that answer out. Thank you, Mr. Chair.
Thank you, Ms. O'Connell. Mr. Obdudov.
Thank you very much. Actually, I do have a question. You've mentioned that 9 out of 10 families will be better off under the new child tax benefit. And that means either they'll get more money or they'll pay less taxes. I'm not sure which one is from the perspective of the taxation, and whether either way there will be a loss of revenue or will be additional expense. And under those two terms, have you calculated what will be the impact on the budget? If it's a revenue, what's the impact of revenue having to acquire and these? Because the money has to come from somewhere.
Well, what I can confirm is that when the costs of the Canada Child Benefit are presented in the budget, so and when specifically when the gain, I guess, to the government from eliminating the universal child care benefit, that's presented net of tax. So that takes account of the fact that now the government is paying the universal child care benefit, but it's receiving a certain amount of personal income tax on
Between the two.
What's the difference? Roughly now, roughly $1 billion is being paid in federal personal income tax to be on the universal child care benefit.
How can we, in that case, $1 billion on the 36 million Canadians, how can you translate that into dollars and cents to a single family?
Oh, how does that? Well, to give you an example, if you thought of a child, is that what you're looking for? Just how, like for a typical family?
I mean, we're saying $1 billion extra. That means it's going to cost the budget is $1 extra billion, okay, as an expense. Now that $1 billion distributed for 36 million Canadians, that translated to very small amount per family. That doesn't mean we're pulling 9 out of 10 families out of poverty, or they will be better off. I mean, they can be better off $100 a year, or can be $800 a year. Nice to know that number, because that's also going to average out to some families. They're going to benefit more. There's some families they're going to get way less. So how can that be such a fair move if the result is only $1 billion extra, throwing extra into that account?
I guess what I can tell you is that the 9 out of 10 figure takes account of the tax that's paid currently on the universal child care benefit. So.
Okay, I have a question. Actually, my colleague asked you about if single mom are eligible for income splitting, implying that income splitting is not fair on that basis. Do the government asking you to review and eliminate seniors' income splitting, because seniors, widows do not qualify? Can you please explain that?
I think what the government made clear in the budget that pension income splitting wasn't being affected by the proposal is to eliminate income splitting for families with children.
Okay, one final comment, Mr. Chair. On my first question, I'm still not very satisfied with the answer, as I don't see that. I mean, you must have done some calculation to get to the bottom of that, especially now with people filing already their income tax, and you must have some close ideas on those numbers. Because it would be nice to know. I mean, it's a very large statement to say 9 out of 10 families are benefiting. Nice to know what that amount is going to be.
It's just.
And how can we average this out based on income brackets? Do you have that analysis?
Oh, what I can tell you is the 9 out of 10 calculation is based on, we have very detailed data on families with children. In fact, on all Canadian taxpayers. So it's based on, it's based on actual Canadians. So we we do these calculations. We have lots and lots of information on Canadian families, and we're able to see how what they're receiving under the current system and what they would receive under a new proposed system. So the 9 out of 10 calculation compares the two. So.
To Mr. Graywall.
Thank you to all our witnesses for coming today. I'm going to take it back to the repealing the education tax credit, and from a student's perspective. So our government in this budget wanted to ensure that more young Canadians had access to post-secondary education, and that the assistance that's going to be provided is more targeted, and that's why we're repealing these tax credits that essentially weren't as targeted to low and middle income families, and introducing an increase in the Canada Student Job Program. Has there been a study done on the impact on an average student from repealing these tax credits and the additional money they will get from the increase in the Canada Students Grants Program?
Are you aware?
I can't really speak.
Okay. Not aware. The Department of Finance officials handled the repeal of the education tax credit and textbook tax credit, and I'd happily go through the details on that. As to the comparison with the Canada Student Grants, that's not something that's in the bill, and so I don't think we're prepared to speak to that. But I'd happily go through what the repeal of the education and textbook tax credits entails, and that's I think all we have at our fingertips right now.
Okay, that's fine. No, I wanted to get more information on kind of the holistic approach, but I guess we can follow up with the Department of Finance on that. From my understanding, can you just confirm that the students that have carry forward credits, like I remember when I was claiming these credits, in certain years you didn't need to use all of them because your accountant, your income was at a certain percentage, or it was more lucrative to save them for another year. They will be able to carry these forward, right? They're not just going to be a full stop on them?
That's correct. Those tax credits would be able to be carried forward, and and claimed alongside the tuition tax credit, which is not being affected by Bill C-15.
Oh, perfect. Thank you. Yeah.
I was looking for Mr. Caron. Guy? We'll just take a moment till he gets here.
Merci beaucoup.
Thank you very much. I have two questions. The first, did you have the opportunity to become aware of the Parliamentary Budget Officer's report relating to the cancellation of the credit for the SMEs that was published this morning?
We have seen the report.
What's your opinion? In your view, is his conclusions in agreement with the Director of the Department of Finance as to the economic impact of the cancelling of such a lowering?
The Department of Finance has not done an analysis of the broader economic impacts of this individual measure. But I can say that the approach taken by the Parliamentary Budget Office here is similar to the kind of analysis that is done by the department. I just say that there's these kind of studies rely on what we call fiscal multiplier effects to look at the broader economic impacts of a particular policy change. So they're based on sort of general relationships that you can observe from past economic studies. There's a fair degree of uncertainty around those things, but generally speaking, this study finds that if the government had decided to go ahead with the previously announced small business rate reductions in future years, there would have been a modest impact on GDP and employment levels. I guess in fact the budget presents an alternative program. The government is proposing not to go ahead with that particular policy change, but to propose an alternative suite of policies, including relying on some measures that are associated with higher fiscal multipliers, things like investments in infrastructure, support for modest and low-income households. And as a result of that, comes up with a suite of policies that would have an overall very positive impact. When you look at the suite of policies overall.
Merci.
Thank you very much. My second question is the following. In terms of the amendments to the Grain Commission, well, am I mistaken to say that this is completing the cycle of the Canadian Wheat Board? And the second question that I have is the relation to the measures that are related to those who transport and sell their grain. Well, is it a provision that existed at the time as the Canadian Wheat Board worked or functioned when it was a Crown Corporation? So why do those elements have to be included now when they didn't exist beforehand?
Bill relating to the Canadian Wheat Board are really based upon the privatization transaction of the Wheat Board and the tax consequences of the structure after that, so going into the future. And what it does is that it effectively is intended to ensure that there is a tax deferral for the affected farmers who participate in the transaction. And if I may very quickly go through how it was structured, and then I can show, I think, probably in the clearest way possible, what these amendments are intended to provide. When the Canadian Wheat Board was commercialized or privatized, a series of deal steps was put in place, and these tax rules effectively respond to those. And what they did was establish a trust for the benefit of the affected farmers, and it would hold an interest in the Canadian Wheat Board Corporation. It was first provided with a promissory note, so a debt obligation, by the corporation, and it used that to acquire shares of the corporation. And then afterwards, when farmers deliver grain to the Wheat Board, they can take back interests in the trust. I think they have a fair market value of around $5 each as part of their compensation for selling their grain. And so if these rules were not in place, just based upon the existing rules in the Income Tax Act, the issuance of the debt obligation from the Canadian Wheat Board Corporation to the trust, I think was in the amount of around $230 million. It was a significant amount in any event. And that would have been included in computing the income of the trust, and it would have had to pay tax on that at the top marginal rate. And so that would have represented a significant tax liability. And so these amendments say that that is not a taxable event. Likewise, the exchange of the debt obligation for shares, there are rules in here providing that that's not taxable. When farmers would deliver their grain to the Wheat Board in exchange for units, that would ordinarily, just under the general rules in the Income Tax Act, be fully taxable ordinary income, and they'd be taxed at the time that they receive the trust units, even though they haven't received cash for those. And so many of the rest of the rules in this bill relating to the Canadian Wheat Board provide a deferral for farmers on that. So they provide that when farmers get those trust units, there's no income inclusion, and there will not be an income inclusion until the farmer ultimately disposes of them, except in the case where the farmer dies and they go to their estate and go to their spouse, in which case another tax deferral is provided. And so really it's about overriding what would have been the ordinary consequences of the commercialization transaction in order to provide a deferral, say more appropriate tax consequences for the affected farmers.
Mr. Carone, I'm going to recognize Mr. Sorbera for a bit, and if there's time, the chairman wants to come back to you. Yeah, okay, you're done. Okay, thank you. Mr. Sorbera.
Thank you, Mr. Chair, and good morning to everyone. I'll just keep my questions very quick and just on one topic. It's, bank recapitalization regime. I just want to make it clear to everyone out there, and I would like to hear that from yourself, that all deposits will be... Oh, it's not in part one. Oh, I'm sorry. Okay. Well, then we'll have to change the question then. Just if we can just talk about the education tax credits and in the fitness tax credits. The one issue I've had for a long time with those tax credits is the difference between refundable and non-refundable tax credits. So I just wanted to ask, is it correct that a lot of individuals won't qualify those tax credits on the lower income scales because of the nature of those tax credits?
You mentioned fitness, arts, and education, and actually there's a variety of treatments if you look at those. The children's fitness tax credit is refundable. The children's arts tax credit is not refundable. And the education and textbook tax credits, they're not refundable, but unused amounts can be transferred to a supporting family member up to a certain amount, $5,000. And they can also be carried forward to future years. So a student might not have enough taxable income to use them in the current year when they're earned, but that doesn't mean they're lost forever. They can potentially be used in a future year, say when the student starts working.
Okay. That's it, Mr. Chair. I'll keep it short.
Thank you, Mr. Sabera. I had some questions on the Canadian Wheat Board, not so much related to the taxation, but, and I think I raised them the night of the technical briefing. Here we are, we're dealing with new arrangements for the new Canadian Wheat Board, but we really still don't know the disposal of assets under the old Canadian Wheat Board. So can anybody tell me what happened to those assets? There was the building in Winnipeg, there's the hopper cars, there was something like $300-400 million from the government of Canada that went somewhere, and I find it remarkably strange now we're trying to make arrangements to invest in a new Canadian Wheat Board when farmers already had the benefit of the old Canadian Wheat Board, which is no more. No, we can't change it, Ms. Raitt. Under international law, you can't change it back. In any event, do you have any answers on the question of sale of assets?
I think the officials at this table are only able to speak to the tax aspects, and in particular those limited to what's in the bill.
Is there anybody here in the room, officials either from agriculture that can?
I believe Ms. McDonald. Oh,
if you could just come to the table, state your name. We just need to know. I know we're getting lots of questions on what happened to the assets.
Thanks, Mr. Chair. My name is Greg Meredith. I'm the Assistant Deputy Minister for Policy at Agriculture Canada, and I was the policy lead on the removal of the single desk and the eventual commercialization of the CWB.
And so, do you have any answers on what happened, the assets of the old Canadian Wheat Board in terms of the sale of the building, the sale of the hopper cars, or who owns them at the moment, and the monies that the federal government had invested? I believe it was in the range of $300 million for the transition.
Yes. So the one point of clarification I'd just state for context, Mr. Chair, is that the government didn't own the wheat board and so didn't sell any assets. And I'd also underscore that prior to commercialization, the Canadian wheat board per se didn't have that much in the way of unencumbered assets. Its primary source of capitalization was debt, and that debt in some cases was guaranteed by the Government of Canada, in some cases not. So, for example, the building was encumbered to slightly more than $1 million or $2 million than it's worth. The hopper cars likewise had debts secured against them. Even though they were donated by the Government of Canada, they used these as equity to build the corporation. And so the monies that you're referring to that were part of the transition fund were to enable the CWB to right-size itself from an organization in excess of about 400 employees to a much smaller organization while dealing with obligations that would have been well beyond its capacity to pay. So, for example, the monies that we gave the wheat board helped pay out pension obligations for those in excess of 400 employees, obligations that the new smaller CWB would not have been able to pay for. We also helped the CWB deal with contracts of affreightment. Those were long-term contracts that they had entered into to transport grain that they could no longer guarantee in terms of volumes, and there were certain penalties that had to be negotiated for those. So there was those kinds of costs largely derived from the decision of the government to remove the single desk, coupled with the decision to ensure that the CWB remained a viable option for farmers in a post-single desk world. And so those policy objectives were supported by those transition monies.
Okay, there is I think there is a recommendation in the Finance Committee report that maybe you can have a look at where we were asking the government, which would include the Ministry of Agriculture, for some answers on these points, and I expect the government will respond in kind. Is there any? One other question I did have on this. On these measures more related to the taxation trust area, would there be a Canadian residency requirement for preferential tax treatment as a participating farmer under the Canadian Wheat Board? Is there anything related to a Canadian residency requirement in order to utilize or be involved in the Canadian Wheat Board?
So the only residency requirement, Mr. Chair, that I'm aware of was that G3 Canada indicated it would be headquartered in Winnipeg. But in terms of a farmer delivering grain to the wheat board, I don't believe it ever came up, but I defer to my Department of Finance tax colleagues on whether there is such a provision subsequent to the commercialization decision.
I'm just double checking, but I do believe that there is a requirement that the participating farmers, which is the defined term in the legislation, be resident in Canada in order to obtain the tax deferral.
Okay, you can continue to look that. I want to move on from part one, but Mr. Ouellette, you have a question on part one. And,
just a very short
Mr.
one.
Lippert as well. Mr. Ouellette.
So a very quick question related to this. So Section 16 relates to failed to file prescribed form. I was wondering how you came up with the number 1,000. So it's actually related to the Canadian Wheat Board and the trusts.
Thanks.
So that's page 49, 16A. In addition to any other penalty for which the trust may be liable under this act in respect of the failure, the trust is liable to a penalty equal to the product obtained when the 1,000 is multiplied by the number of days during which the failure continues. I was wondering how you came up with 1,000. Seems excessive if you're a small farm.
Oh, that's not for farmer. That's not for participating farmer. That would be for the information return required to be filed by the trust itself. which would, on initial capitalization, have at least hundreds of millions in assets. And the policy justification behind requiring that form is, as can no doubt be appreciated, the desire to make sure that information is kept up on the operations of the trust, and that there are adequate reporting requirements on its activities to make sure that it is continuing to meet the policy objectives that are reflected in this bit of legislation.
One last one.
Question rapide, en fait, qui est un suivi.
Very quick question, and it's a follow-up to the question that I asked of Mr. Green as to the impact of the cancelling of the tax reduction on SMEs. I was wondering if there is an economic impact on the SMEs. And is it a standard within the Department of Finance and not to proceed to such analyses or studies for measures that might have an economic impact? When we're talking about tax reductions, will there be decisions that will be taken, behaviors that will change? And this will have an impact not only on the growth of businesses themselves and relative to their economic efficiency, but also on the Canadian economy in the long run. So I'd really be curious to note at what time does the department decide to do an impact study of certain measures, and when does it decide not to carry out such a study?
In this case, the government, the department did, in order to support the budget, put forward studies on or did look at the impact of the budget as a whole, and it grouped the measures together. I can point you to the budget plan for 2016. Annex 2 of the budget sets out the economic impact of budget measures, and there it divides up measures into broad categories, so that the corporate income tax measures were grouped together, and at that scale, they were found not to have a kind of a particularly material impact at that high level. But very much the government does consider the impact of measures. But budget making is about making choices between different alternatives. And when a government puts together a budget, it looks at the economic impact of the complete ensemble of measures, and that's what's set out in the budget, with just those sort of macro level breakdowns.
Mais j'aimerais juste compléter en disant qu'il s'agit.
I'd like to add that we're still talking about an element that's different from the report from the Parliamentary Budget Office said this morning, because it said it could have a negative impact, according to the Parliamentary Budget Officer, as to the economic growth of SMEs, and they have a role to play in Canada's economic growth. And so what's indicated in Annex 2 says that there's not such an impact that might take place. So there's an important difference relative to the findings from the department and from the Budgetary Office.
Question, actually.
Okay. Go ahead, Mr. Kane.
I guess I would just say that the impact that was pointed out by the budget officer, yes, it is a negative impact, but on the order, the figures in the budget, go out to the second year of implementation, 2017-18. The Parliamentary Budget Officer finds a negative impact on GDP of $30 million. So that, in the figures that are presented here, that would have been a rounding error. So, and when combined with the impact of other measures, you just don't see it. But it was certainly, the impact of the measure was certainly taken into account. But it's small in terms of the overall picture.
Last point, and then we're moving on.
Monsieur le Président, je voudrais continuer sur la ligne de questions.
Mr. Chair, I'd like to follow up on Mr. Caron's question. I'm reading the report from the PBO, and we're talking about a financial impact of less than $45 million and an impact on 70 employees for 70,000 70 employees for 2017, 2018, and so it's a rather minor impact. So it seems to me that when we're talking about a growth rate of 0.5% and of 1% in the next fiscal year, and so in an economy of $200 billion, we're talking about $20 million relative to $45 million, and we're talking about the growth of 100,000 jobs. So I'd like for you to establish a perspective as to the impact of that measure in the budget.
Green.
Thank you, Mr. Chair. Yes, I confirm that the honourable member, the parliamentary secretary, is pointing to the impacts that are set out in the budget plan in the annex that we've just been discussing on page 256 of the plan, which again are for the ensemble of measures in the budget.
Okay, thank you. Then moving on. No member asked for a briefing on Part 2 or Part 3, both parts which relate to amendments to the Excise Tax Act, GST, HST measures, and excise measures. But does anybody have a question in those two areas?
But it's in the projection side. I don't know whether or not the officials are able to answer the question for me.
Do you want to find it, Ms. Wright, and then we'll...
Yes, please. Thank you very much,
and
Mr. Chair.
we'll come back to it.
Indeed.
Then starting on Division 1 of Part 4, the Federal Balanced Budget Act, somebody asked for a briefing on that. Who was it? Does anybody have a question? Yes, the other officials who were changing officials come up to the table, and thank you, Mr. Long, those who were here. Okay, we'll start with that. Yep. Division 1, but we'll go to a question from Ms. Wright first on the on Part 2, Part 3.
Few questions in Division 4.
Okay.
We're going to
on which one? Thank you very much, folks. Okay, Mr. Recker? Where's my list here? Yes, Mr. Recker is the Senior Chief Expenditure Analysis and Forecasting Economic and Fiscal Policy Branch. Thank you. Ms. Wright, you have a question.
Page 235 of the budget gives outlook for budgetary revenues. Under the GST, there it goes from revenues 31.3 in 2014 all the way up to 40 in 2020-21. The rest of the excise duties, taxes, collections seem to be flat, if not going down. Why is there such an increase in the GST?
I'm actually the Senior Chief of Expenditure Analysis and Forecasting.
I heard expenditure, yeah.
Yes, exactly.
So how is the government spending all the GST they're going to collect? No, I'm just joking. Okay.
I think the...
Question lodged.
Sure.
Anyway, if someone can get back to me on that, that'd be
absolutely.
awesome. Thank you.
Minutes and Mr. Caron, you had a question on Part 2 and Part 3?
No, actually I don't. It's for Part 4,
okay.
Section 1.
Okay, then going to Part 4, if we could go through them by division. Division 1, Federal Balanced Budget Act. Any questions in that area? Or were you prepared to give a little bit of a briefing first?
I can just mention exactly what it is. It's only the one line. It repeals the Federal Balanced Budget Act, or proposes the repeal of the Federal Budget Balance Act, deeming it to never have come into force.
Mr. Caron.
Est-ce que vous pourriez me confirmer que
Could you confirm that if there is no change that was brought to the Act, so can you confirm that if there was no change that's brought to the Act, if it was still in effect, and it will probably be the case as of the 1st of June, so that as of the 1st of June, the government would in fact be violating its own Act?
Act, which was passed with the with the Budget Implementation Act from Budget 2015. The government would need to impose an operating budget freeze on departments and a salary freeze on ministers and deputy ministers that would come into force actually this fiscal year, and it would extend until a return to balanced budget is achieved.
Je comprends les implications, mais la question c'est...
I understand the implications, but the question is, as of the 1st of June, if I'm correct, the government would then have to take those measures according to the Act in light of its budgetary situation, so would be violating its Act and would have to put into effect those measures. Is that correct?
Act, those measures are expected to come in force this fiscal year. What the government has chosen instead to do is to propose a repeal of the Act, deeming it never to have come into force.
I do understand. What I want to know is, basically, the government has chosen to retroactively cancel this act, and basically, in the language of the bill, basically is saying that this act never existed, so that all the consequences it should face according to this act will have been deemed never to have taken place because the act didn't exist in the first place. Have we seen many examples of this formulation in the past?
I'm not an expert of past legislation.
Was
only
the
the
Justice Department consulted on the impacts of this type of formulation of retroactive change?
I wasn't. I'm from the Fiscal Policy Division. You would have to speak to our legal branch in that case. Okay.
Would it be possible to actually, you said that, Monsieur le Président, vous avez dit qu'on pourrait convoquer d'autres témoins, d'autres fonctionnaires.
Mr. Chair, you said we could ask other officials to come relative to those questions, and so would it be possible to have somebody here? Thank you.
And try and get someone here on that, just to explain where we're at and to help out officials that they're here for the right questions. We are going to go through the divisions in the bill, and when the clerk asked finance officials, we asked them to come on areas that people felt they would have questions. So Division 1, 2, 4, 5, 9, and I know you have a question on 8, Ms. Raitt, 12 and 14. So we'll have to go through them one by one if we can. Is there any more questions on Division 1? Mr. McKinnon.
Well, on the same line of questioning as my colleague, Mr. Carr, are you aware of any legislation on the books that would require that would be able to predetermine the fiscal policy of one government or one parliament from one parliament to another?
Not for the federal government, no.
So the very existence of a balanced budget act would be unprecedented in your view.
At the federal level, it is unprecedented.
So indeed, the precedent that we should all be recoiling from here is the precedent of trying to bind one parliament using the previous parliament.
More a political question, I believe, Mr. McKinnon, for officials. Okay.
I actually have one more.
Okay, you do?
Just to punctuate the fact that Mr. Caron seems that to think that it is unprecedented to imagine that a law that should not that a law did not exist, or to pass a law saying that a law did not exist, but a law that should never have existed does not exist is probably good public policy.
Okay, I don't want to get into extended debates here, but Mr. Caron, a quick one. We're going to soon start running out of time.
Mes questions sont pas par rapport.
My questions aren't against or for a principle relating to a balanced budget, but rather the question is whether it is a difference relating to the principles of fundamental the rule of law. And Mr. Recker said that a balanced budget act does not exist, or there's no precedent for it at the federal level, but it does exist at the provincial level, and it's the same tenor as what we have before us now. So there are precedents that exist that don't necessarily require for this government to change retroactively an act and withdraw from that act by saying that it never existed or never really existed.
To Part 4, Division 2, and call Faith McIntyre to the table. And this section represents the changes to the Canadian Forces Members and Veterans Reestablishment and Compensation in the Budget Implementation Act. So who do I have for questions? Mr. Caron, go ahead. Oops, wait till Ms. McIntyre is ready. Could you give us a little briefing, if you have it in mind, first, Ms. McIntyre?
Yes, I can. Thank you very much, Mr. Chair. So Part 4, Division 2, Articles 79 to 116 of the Act, and it's an act to amend the Canadian Forces Members and Veterans Reestablishment and Compensation Act, which we more commonly refer to as the new Veterans Charter. There are 4 areas that are being proposed for amendment in this division of the Act. The first area would see the increase of the earnings loss benefit from 75% to 90% of a veteran's monthly gross pre-release salary. And the earnings loss benefit is an economic impact benefit which recognizes the service-related disability on the impact for that individual to earn income following release from the military. And that change would take effect as of October 1st of 2016. The second change that is proposed is a change to the permanent impairment allowance. Firstly, in recommending the change of the name to the career impact allowance. The permanent impairment allowance is an economic benefit that recognizes the lost opportunity that a permanent impairment has on employment and career progression. So the name permanent impairment allowance does not accurately indicate what the award is for, hence why the proposal to change the name to career impact allowance. And also another name change to the term totally and permanently incapacitated to diminished earning capacity. Again, in order for an individual to receive this award, they have to demonstrate that they do have what we'll now be referring to, if this act goes through, as a diminished earning capacity. Furthermore, in terms of the permanent impairment allowance, we are proposing to add an element to individually assess the impact of the service injury on a veteran's career advancement opportunities. Right now, there is no assessment that actually provides for that measurement of what the impact of loss of earnings due to their service-related injury or illness. So the proposal would provide for a functional capacity assessment to do so. And that change would take effect as of April 1st of 2017. Puis les deux autres changements qui restent.
And the 2 other changes that remain are dealing with the disability award, which is a lump sum payment that recognizes the non-economic impact for pain and suffering. And of course, we're making the proposal of increasing the lump sum payment to $360,000. And at the moment, it is $310,000. And so, of course, there's going to be other changes to other benefits that work together in the context of this maximum lump sum payment. And this will come into effect as of the 1st of April 2017. And there will also be a retroactive payment that would go back to the April of 1st, 2006. And the last changing would be clarifying wording around when and how a disability award are payable and how they're calculated. And so generally those are the four changes that are being proposed in this division of the Act.
Kintar, just to start, I think Mr. Caron has a question, but in terms of the assessment you talked about, who will do these assessments on veterans or military personnel, and is there an appeal process, or is it DBA?
So thank you, Mr. Chair. The functional capacity assessment, we are currently working through exactly how that would be implemented. It will be part of the regulations that we are now writing and would come after this legislation is passed. However, we're looking at different methods to do so. An example are current service providers that we have that do this type of assessment for other individuals, such as Workers' Compensation Board. It's not a new assessment. It's an assessment that's used in many other jurisdictions to measure a future loss of earnings, if you will. In terms of how that could be appealed, there certainly are always mechanisms within which to do such, but again, Mr. Chair, we're currently working through those provisions that would form part of the regulations moving forward.
Okay, and I neglected to introduce you. Ms. McIntyre is Director General Policy and Research Division, Strategic Policy and Commemoration with the Department of Veterans Affairs. Mr. Caron.
Thank you. My first question is, you're not at the Department of Finance, you're at the Department of Veteran Affairs. So my question is very simple. The bill was a bill that was tabled by the government. It's Bill C-12. It's the same bill, and it hasn't been amended since its initial tabling. That's correct. And to your knowledge, when it was tabled under Bill C-12, was it supposed to go to the Department of Finance or to another committee of the House of Commons? Answer, I don't have an answer to that question, unfortunately. I can't answer that question. I'm not sure. Well, initially it was supposed to be looked at by the committee that deals with veteran affairs issues. And so we have a bill and a budgetary plan. I think it's about 20 pages when we talk about the bill, and that already has 159 pages and has gone to 179 through the inclusion of measures that weren't for the the Committee of Finance, but rather the Committee on Veteran Affairs. And so you can't convince us that this is not an omnibus bill, but all these measures nevertheless are in the budget, and so that means that all of the bills that are tabled by the government, apart from criminal legislation, will be found in an omnibus bill, because all those measures might eventually find themselves in a budget or a line item within the budget. So thank you very much. That was my comment.
Mr. Sobera.
Thank you, Mr. Chair. It seems like many components of this division relate to money matters, so I'm glad they're brought forward to the Finance Finance Committee. I was just curious about Clause 82, the increasing the percentage from pre-release gross income from 75% to 90%. And if I'm reading this language correctly, and forgive me because I'm not a lawyer, this means that obviously there would be an increase in the situation of veterans being able to receive an income of up to, or at a minimum level of 42,000, I believe it is, 42,850, if I'm reading that correctly.
So yes, thank you very much for the question. Indeed, it's 75% to 90% of gross pre-release salary is the adjustment that's being proposed. Certainly, it would be in individual circumstances if the veteran would actually receive the full 15%, because there are offsets that are calculated as well from employment earnings, which are provided for under the regulations. However, it certainly is an increase, and every veteran would see an increase to that extent. The amount that you're referring to would be the minimum salary that equal to that of a senior private. That would be the minimum salary that would a veteran would actually have.
No, I'm fine. Thank you.
Mr. Ouellette.
So that amount could be different if you're, for instance, a corporal or a sergeant or a captain.
The amount is 90% of your pre-release, what is being proposed pre-release salary. So yes, it would be different depending upon what your rank is throughout your at the end of your military career.
And it's as long as you have a disability.
The earnings loss benefit, so eligible veterans for the earnings loss benefit do have to participate in a rehabilitation program. So that is, there is eligibility criteria that a veteran would have to meet in order to receive the earnings loss benefit, yes.
Thank you.
Caron.
Une question rapide.
A quick question. We have seen the case of a former veteran who couldn't receive his benefit year after year, and every year he had to indicate that the legs that he had lost hadn't grown again. And so is there a provision in this bill that will put an end to this type of practice? Answer, yes. Well, thank you very much for that question. It is a question that is often raised. The form in issue is not a form by Veterans Affairs Canada, but I know that there are amendments for the documents, and not a change in the Act, but rather a change in the documentation that was required of veterans and of their doctors. Of course, we're trying to ensure that all those forms are designed for client service, and so we've done a lot of work to reduce the numbers of forms that have to be filled out, to simplify it and simplify the wording. But I can tell you that there has been change to that specific document that you're referring to. Thank you very much.
Mr. Ouellette, one quick question.
So just a quick case. So let's say you get hurt around your 10th year of service, your career progression moves on. You were starting out a corporal, you might have said you could have finished up as perhaps a sergeant or something like that. You get 90% because you're very, perhaps you're very hurt, but you reach retirement age. What happens at retirement age, like 55 or 65?
Okay. Thank you very much for the question. So after age 65, there are actually two current benefits to which the veteran might be eligible for. Again, it would depend on their post-retirement earnings and also some other eligibility criteria that they would have to meet. One is the supplementary retirement benefit, which is actually a percentage of their earnings loss benefit that is kept aside for them and that they receive in a lump sum payment at age 65. And secondly, there's the retirement income security benefit, which came into place in budget 2015, which is payable after age 65.
Thank you very much, Ms. McIntyre. Division 4, Part 4, amendments to the Bank Act Federal Credit Unions. If we could call up Glenn Campbell and Margaret. How do you pronounce that name?
I'm not sure, actually. I want to ask her. That's what
Tepchinska?
Approximately, yeah.
Yeah, they test me. Miss Tepchinska?
Tepchinska, yes.
Oh, I have difficulty with names. And you're Senior Economist, Financial Institutions Division, Financial Sector Policy Branch, and Mr. Campbell is Director, Financial Institutions, Financial Sector Policy Branch. Do you have a brief starting comment, and we'll go from there?
I do. Thank you,
ahead.
Mr. Chair. The proposed legislation contained in Part 4, Division 4 of Bill C-15 amends certain provisions of the Bank Act relating to federal credit unions. The government is acting to address the unique transitional risks credit unions entering the federal framework may face due to the differences between federal and provincial regimes. The Federal Credit Union Framework within the Bank Act was put in place to offer the sector an option to grow regionally or nationally if they so choose. The framework is neutral and does not incent federal entry. There are three main amendments. The First Amendment provides the Minister of Finance authority to exempt an applicant from a federal technical procedural entry requirement so long as the applicant substantively meets the intent of the requirement. In short, in certain circumstances, there are federal requirements and provincial requirements, and to avoid a problem at the end of an application period, there is, with a compelling reason, flexibility there to follow a provincial rule. The Second Amendment provides the Minister of Finance authority to exempt federal credit unions from certain technical procedural requirements relating to voting up to 3 years after they have entered, so long as they have substantially met the intent of the requirement. This gives some flexibility to electronic voting, in particular where there are some differences between various provinces and federal. Again, this flexibility exists providing they substantially meet the federal requirement. The Third Amendment provides the Minister of Finance authority to offer a transitional loan guarantee to a federal credit union for the purpose of supporting it through its first 3 years. Credit unions could face uncertainty during transition. The loan guarantee would be a safety net, providing insurance value. It would also potentially provide a stable source of funding if funding challenges exist and credit unions need it. The measures are in addition to transitional support that already exist in the federal credit union framework and provide targeted protection against transitional risks. The measures continue to refine the federal credit union framework in response to demands from the credit union sector. There was also a small technical housekeeping amendment on French concordance that has no policy effect. Thank you.
Thank you very much, Mr. Campbell. Yes, and we'll turn to Mr. Graywall. Just, we are going to run out of time, and we'd hope to deal with the witness list. Could we have agreement from committee? There's a number. There's 5 witnesses that the clerk has called for Thursday that relate to commonality across the parties. Could we agree that the clerk take the first 5 off each priority, in priority of each of the parties' lists to work with, to get the witnesses for Thursday? They're all in priority, I think, Ms. Reid.
We had a discussion about that,
Okay.
Mr. Chair, on our side. That may not reflect our current thinking.
Okay, can you give your 5 to the clerk?
Yes, we will.
And I think ours, we'll give our 5, Mr. Sabera, and yours are in order, I think, are they, Guy? Are yours in order of priority, your
Yes, they are.
witnesses? So we'll ask the government and the official opposition to give us their 5 so the clerk can work with them and take the, okay? Okay, Mr. Graywall and then Mr. Abultov.
Thank you, Mr. Chair. Quick question. In the history, how many credit unions have failed, like federal credit unions?
Actually, there has not yet been a federal credit union that exists, and there is one formal applicant before the government right now, la Caisse Populaire Acadienne, soon to be renamed Uni Coopération Financière. They would be the first federal credit union.
Patent, right, under the Bank Act. So then, okay, I'll revise the question. Within provincial jurisdictions, do you know of how many credit unions have failed?
Actually, I don't have the specific data at my fingertips. However, I can say the provincial system has been quite adaptable at consolidating credit unions. When they face trouble, stronger credit unions often pick up smaller credit unions, and really there's been a reduction by the hundreds of credit unions over the last 15 or 20 years. So I would not want to portray these as failures per se. Often it's a natural consolidation that happens inside provincial regimes.
So the risk is pretty small in terms of absolute solvency issues?
From a solvency point of view, the risk is lower. given that most credit unions, whether they're provincial or federal, would be engaged in what we would call plain vanilla activities, taking savings, simple loans and credit. They're not involved in risky capital markets activity by and large. Some of the bigger ones are, but they largely do that for funding purposes. But by and large, credit unions are really simple financial institutions, and they have a good track record that supports that.
So in your opinion, in the government guaranteeing these loans, there won't be a substantial fiscal cost to the government?
In this case, there's no direct fiscal provisioning required on a loan guarantee. Given the nature of the loan guarantee that supports, there is a Treasury Board guideline and a history of the federal government providing loan guarantees. There is a lot of thresholds before this can even be tapped. And the scenario under which there would actually be losses, it's very remote, and it's not technically insignificant, but it's highly unlikely.
Thank you, sir.
To raise one question as a follow-up there, Mr. Campbell, is it not fair to say, however, that had there not been significant provincial government bailouts of credit unions on occasions in the past, there would have been significant failures?
I think that question is beyond my remit to answer.
I think it needs to be put in the context that while there haven't been failures in the past in the credit union movement, there have been significant provincial backstopping costing significant numbers of dollars.
I would say, if I could step back, generally speaking, provincial credit unions largely are managed through their deposit insurance arm. In some cases, there's two entities. And where there may have been cost borne, it could have been in their deposit insurance fund. I'm not aware of statistics that attribute back to what the fiscal costs may have been. Clearly, there are costs often borne when institutions are consolidating, but I think you'd have to call provincial experts to the table to answer that question.
Thank you.
The proposal or the change that there's two items here: provide targeted protection through a loan guarantee, so on. So the question that comes to mind is who we are trying to protect here, who's the government trying to protect, and why this is now. Is this something we anticipate that we're going to go through down the road? Is there some policies might be affecting banking institutions or credit unions? What is it?
Thank you for the question. The development of the federal credit union framework has taken, I would say, almost a decade to put in place, given the demands of the sector wanting a federal option to be able to grow regionally or nationally. So the government and Parliament has responded over the years of developing this framework. Throughout that process, many credit unions have indicated there is uncertainty in moving provincially to federally, and given the uncertainty, that could include impacts on their ability to fund themselves under certain scenarios. So the loan guarantee is mainly to deal with transitional risks moving from the provincial system to the federal system. There are some differences in various provinces. And obviously the criteria is the members have to agree of that institution to move federally, the province has to agree for that institution to move federally, and federal supervisors and the minister has to agree to receive them. Throughout that process, a member could choose to leave that credit union and potentially remove their deposits or to no longer be affiliated. There are scenarios, transitional risks that this is trying to mitigate, and it has been raised by the credit union sector for a long-standing period, that in order for them to make this decision, having some provision to promote financial stability through that initial period would be helpful. So to answer your question, this is really about financial stability for the institution and for the system.
Rational, but you did it.
Okay. And, thank you, Margaret and Glenn. Turning to Division 5, Bank Recapitalization Regime Bail-In, we would call Dan Robinson and Alexandra Dossel to the table. So, find your names on here. Ms. Dossel is Senior Chief Framework Policy, Financial Institutions Division, and Mr. Robinson is Senior Project Leader. Any questions on Division 5? Mr. Sabero.
Okay. Thank you, Mr. Chair. Just first, kind of just a clarification question for many out there that any sort of event for or a need for bank recapitalization would not impact depositors. Is that correct?
It is correct. Mr. Chair, I had a statement, if you wanted me to read at the outset.
Sorry, Glenn, go ahead.
Because it does, in fact, answer the question, and let me start with that in saying, yes, all deposits are out of the bail-in regime, and they're not contemplated here in any way, and I'm happy to answer questions in that regard. By quick summary, the proposed amendments in Part 4, Division 5 provide a legislative framework for a bank recapitalization, or bail-in regime for short. Bail-in is the power to convert certain debt of a failing bank into common shares to absorb losses, recapitalize the bank, and allow it to keep operating. Clauses 126 to 168 amend the Canada Deposit Insurance Act and the Bank Act to implement the bail-in regime, with consequential amendments to the Financial Administration Act, the Payment and Clearing and Settlement Act, and the Wind-Up and Restructuring Act. These amendments build on the existing provisions in the CDIC Act that relate to managing the unlikely and remote scenario of a bank failure. Amendments to the CDIC Act would provide CDIC with the power to undertake a bail-in conversion. Specifically, the corporation would be able to convert some of the failing systemically important bank's long-term debt into common shares. This would only apply to certain long-term debt securities prescribed in regulations. Deposits would be excluded. The proposed amendments include updates and enhancements to existing provisions of the CDIC Act in order to ensure that they function effectively with the bail-in power. These include CDIC's power to take temporary ownership or control of a bank. 2, provisions setting out how bank creditors and investors can seek redress or compensation from CDIC following a resolution process of a bank, in short, if they were bailed in. Provisions aimed at preventing the termination of the bank's contracts in the context of a resolution process, again, to keep it operating to protect customers. Finally, proposed amendments to the Bank Act would first enshrine in legislation the ability of the Superintendent of Financial Institutions to designate banks as systemically important, thereby making them subject to the bail-in regime. Second, allow the Superintendent of OSFI to set a requirement for the banks to maintain sufficient loss-absorbing capacity on an ongoing basis. This requirement will be met through an additional capital or debt subject to the bail-in power. The proposed bail-in regime has been the subject of extensive stakeholder consultation, including with banks, credit rating agencies, and investors and creditors themselves. The full coming to the force of the regime will follow completion of regulations, which will allow for additional consultations on the technical elements and allowing a smooth transition for stakeholders. The proposed reforms in the division are in line with international best practices and standards endorsed by the G20 following the financial crisis. Thank you.
Mr. Chair.
Campbell, Mr. Sabera, and then Mr. Caron.
Thank you, Mr. Campbell. This piece obviously came out from the OSFI consultation paper, which was released, I think, about 2 years ago, and asking for feedback. And we already know that we have what's called NVCC subdebt and NVCC preferred shares in the market that are trading. The last aspect is to put in place what we call here long-term debt, which would be the senior component. We have the senior debts trading. The existing senior debt's grandfathered, from my understanding, from the OSFI consultation paper. Any sort of timeline that we think in terms of getting the last piece, the third and last pillar in terms of the NVCC senior long-term debt in place in the market?
Well, first, let me come back and clarify. for the record, Department of Finance, the Minister of Finance consultation paper on bail-in, although we work very collaboratively with all agencies going back internationally, it is quite correct. There's already existing instruments that are convertible, such as the NVCC instruments that you had that you had mentioned. In terms of additional NVCC, Alex, do you want to answer?
Just to clarify, so non-viability contingent capital, that requirement exists, and it's administered by the Office of the Superintendent of Financial Institutions. As you correctly point out, what we're proposing to do here through the legislation is to have eligible senior debt be available for bail-in. Before the regime would be able to come into force, the legislation would first need to pass. Subsequent to that, there are a number of regulations clarifying particular components of the regime that would have to be put in place. Before those regulations could be passed, they would be pre-published, and there would be a consultation period before that. So it is still a number of months, even after the legislation would pass, until the regime would be in force.
Thank you. It's good to see progress on this front.
Mr. Caron.
En fait, deux choses, mais avant de...
I have two things. I had a couple of questions, but since we don't have much time, I would like for us to discuss quickly. I don't think this will be a problem, but it's in relation to the motion that Mr. Dussault tabled at the last meeting. And so here we're talking about CRA. The motion said that the committee is asking CRA to provide all the written correspondence and exchange of letters and emails between CRA and KPMG that took place between the 1st of January 1987 to 1996 on the island of Le Mans, and that all that information provided to the committee at the latest the 18th of May 2016. So there are proposals for two amendments that are asking that one should be compelled, or as opposed to ask instead of compel, because the CRA is willing to provide that information. And then the second suggestion was that one should ask the information that is not subjected to Section 241, and so that we don't have any problems with that. And so we would ask you to look at those amendments, and if that's satisfactory, then we could vote on that right away.
To amend it, Guy, if I could, that the committee request the Canada Revenue Agency to provide all written correspondence, including but not limited to the letters and emails between the Canada Revenue Agency and the KPMG accounting firm, issued between January 1st, 1999 and May 5th, 2016, regarding the Isle of Man tax plan and any matters related to that plan that is not subject to Section 241 of the Income Tax Act, and that the documents be provided to the committee at the earliest possible date.
That was not mentioned, as we still wanted to have May 18th as a date. It was in the original motion.
Did you want May 18th in there? Is there agreement on that?
I think it would be important to have at least documentation before the minister comes in.
Can I hear...
It'll be at the earliest possible date.
You're saying at the earliest possible date. You can't support that.
I can't. I mean, if we're saying the earliest possible date, who determines what the earliest is? We're leaving the CRA to actually give the documents. If they determine it's in like September,
them to give.
I'm asking them on a specific.
Hold it, guys. We'll have to Mr. Caron first.
Yeah. Je demande à ce que des documents qui sont.
I'm asking for very specific documents. We're not asking for the document relating to what CRA might be able to provide. I'm talking about correspondence between CRA and KPMG only relating to the issue relative to the mechanism that applies to the Isle of Man, and that's it. And so we're not talking about documents, 10,000 pages of documents. Rather, we're talking about a very specific request and I would submit that it is relatively easy to find, keeping in mind the search engines that we have relative to the emails that were sent. We're not working at the time where there were huge boxes of documents that were archived and took weeks to find. So I'd like for this motion to be accepted in order to have as much information as possible. And if we can have partial information on the 18th of May, and there's going to be additional information that's provided, so well, but we need specific information in order to be able to target our questions to the minister.
Quite what you said. Your motion really would be that the documents be provided to the committee on May 18th. Am I correct on that?
That was what Mr. Dussault
Now,
presented.
Is there an amendment to this?
Sorry, Mr. Chair.
Yes.
Is it possible to bring an amendment at this stage?
I think we're looking for kind of an agreement here based on what we talked about yesterday. The dispute seems to be everything else is in order, with the exception of Mr. Caron is saying May 18th, and you folks are saying something different. So the motion that's on the floor, I believe, includes May 18th. If you're moving an amendment at the earliest possible date, the committee, I think, is open to it.
Can we propose the amendment, Mr. Chair?
Yes.
The amendment would read at the end there, at the earliest possible date.
So the amendment's on the floor. Mr. Caron.
J'aimerais savoir si le côté libéral.
I'd like to know whether the Liberal side has other ideas to dilute the motion to give it less and less impact, because it would not be useful to hear all the arguments. We tried to cooperate, and we've accepted other amendments that were suggested, and instead of compel, we've said ask, and we've also referred to things relating to Section 241. We acted in the spirit of cooperation, and there's a third amendment that was never talked about prior to that. And if the government wants to propose something else that is more diluted to ensure that we don't have the information at time, and I would like to have access to those amendments in order to know that this motion is going to become less and less effective. Mr. Chair, we have to reestablish the facts. There's nobody on this side of the table who doesn't want to cooperate. What we're explaining to the committee is an issue of having asked him for 17 years of correspondence, and it takes a certain amount of time to get that. On this side of the floor, we want to have the same outcome as our colleagues, but to say that we're not acting in good faith, to say that systems take the time that it takes in order to be responsive.
17 years of emails in an agency that they need the time with the proper system to be responsive. That's what we're doing, but I will not take the argument from the colleagues that we're not being responsive. We're responsive, but we need to deal with the systems that are in place. We want to give a full answer, but we need the time to do it. That's what the department says. So there's no portraying of us not trying to collaborate. We are cooperating. We check, and the systems people are telling us they need more time. That's the simple answer.
Okay, Mr. Caron.
M'excuserez si.
I'm sorry if I don't trust that the government really wants to go to the end of this analysis. When we're preparing a motion whereby we're asking for KPMG, the minister, and the agency to come before the committee, and it's defeated, and there's a motion that excludes the presence of the minister, but that might be amended. But also at the House, we say that this Liberal MP that tabled the motion to indicate the good faith of the government. Well, perhaps you'll understand why I don't necessarily believe in the good faith of the Liberal government. What I'm wondering here is whether we can have information that we need in order to be able to ask questions of the minister. And if there's dilution of this motion, as is the case for other motions, that will be the case because you have the majority on the Liberal side. But I hope truly that we won't take advantage of this opportunity to let this study fall between the cracks, and that we won't be able to go into things in detail.
This is on the amendment.
Yes. Yes. Mr. Chair, I would like to put in, obviously, move the amendment for at the earliest possible date. I think that's the most practical step we can go forward. We do not want to dilute the motion ahead. We have the minister coming to our committee. We want to get to the bottom of the issues that have been raised and ask the pertinent questions. At the same time, we are asking CRA and officials and related entities for a lot of information. And this is the most practical measure that we can ask for in terms of getting the information we need.
Mr. Grable.
Can we have the amendment read one more time and then vote on it?
The last part of it would. Pardon?
No amendment.
Okay.
All of it.
Okay.
Yeah.
That the committee requests the Canada Revenue Agency to provide all written correspondence, including but not limited to letters and emails between the Canada Revenue Agency and the KPMG accounting firm, issued between January 1st, 1999 and May 5th, 2016, regarding the Isle of Man tax plan and any matters related to that plan that is not subject to Section 241 of the Income Tax Act, and that the documents be provided to the committee by May 18th on the original amendment and on this amendment at the earliest possible date.
Okay, so we'll vote on now on the earliest possible date.
Earliest possible date. Mr. Caron.
Would the government be receptive to actually an amendment following this amendment that would actually say that the CRA, Canada Revenue Agency, would actually provide this committee with the information that they gradually find specifically related to the motion as they find it, instead of waiting until a date that we don't know of in the future that might very well be June, July, August, or September if the CRA decides that this is the earliest convenient time.
So what are you asking, Guy?
I'm asking if the government would be receptive to an amendment saying that all that correspondence information related to the motion that they find will be as it is found, sent and shared with the committee.
I'm going to take the question on at the earliest possible date. We can consider that as an amendment later. All those in favor at the earliest possible date? Amended? Opposed? Carried. Motion as amended. Mr. Caron.
I'd like to add, at the earliest date, provided that the Canada Revenue Agency forward to the committee any information it finds when it is found related to the motion.
When it is found.
When it is found?
When it is found, yes, that it's immediately shared with the committee.
I think the understanding here is that the CRA provide as much information as they can before the minister appears on the 19th.
Yeah,
I think that's basically what you're asking. Is that fair? No, it's not. Are we okay with that? Okay, all those in favor? And we'll opposed? Carried. The motion is amended. All those in favor? That was another amendment, Mr. Champagne. The motion is amended.
Not sure what was clear, Mr. Chair, what you ask us to vote now.
On the original, on the motion as amended.
I cannot vote, but I want to know what we're voting on.
The understanding is that the motion at the earliest possible date, but what we're basically telling CRA is provide what they can for us on May 18th, progressively. Okay, all those in favor of the motion? Opposed? Carried. We are practically out of time, sorry.
I've been on notice for a long time on my motion, Mr. Chair.
What's your motion?
A long time ago.
Oh.
Referring to the minister. That should be
referring to the minister. Like 3 meetings ago.
Sorry, witnesses. The motion by Ms. Raitt. Yes, go ahead.
I was the next, I think, in line to speak.
She can pull her motion up at any time.
Do you even? Okay.
The motion was that the committee invite the Honourable Bill Morneau, Minister of Finance, and officials from the Department of Finance to appear as a witness for the committee's deliberation on Bill C-15, an act to implement certain provisions of the budget tabled in Parliament on March 22nd, 2016, and other measures. That was the motion. We agreed at subcommittee yesterday that he would come on March 30th.
Great, perfect.
So, on May 30th, sorry.
Great.
You want to pass this?
Yep.
And we're agreed to the May 30th.
Yeah.
Okay, all those in favor? Opposed? Carried. I've got, sorry, Mr. Ouellette. You wanted, what did you?
Okay, great.
What was your?
So, no point of order. Anyways,
before you raise your question, I do have one motion we have to deal with that relates to this meeting, and I'll read it. And
my question then is, will these fine ladies and gentlemen be coming back to this committee?
We're going to have to ask them back because we didn't deal with Division 9, 12, or 14. We'll have to find, we'll see if we can, I doubt if we can. I have one motion that I want to put, if somebody can move it, that the evidence and documentation received during today's committee meeting in relation to its subject matter study of Bill C-15 be deemed received by the committee in the context of its legislative study of Bill C-15. Moved by Mr. McKinnon. All those in favor? Opposed? Carried. Okay. Is there any questions on Division 5 further than have been raised? Mr. Caron.
Merci.
Thank you. You mentioned, and this is something that I was reading as well, that there are various elements that are going to be established through regulation afterwards and not in the Act per se. So I understand your explanations as to the fact that deposits are not included in the liabilities, bank liabilities, but the definition of what is considered to be a liability is not in the Act. So it's going to be defined through regulation. Is that correct? And the regulation itself does not require participation of the House of Commons of Parliament, and it can come from a Governor and Council order. Is that correct? So what is of concern for people is the fact that in the long term, their deposit could fall under a risky element, and so is there a definition whereby it couldn't be changed by an order in Council? Because if at the time, and I accept the fact that the will is to exclude them, but are there significant obstacles to a future government in a more difficult economic context where they could modify the definition and include a deposit? That's what is of concern to me, a future government that finds itself in a different context.
Let me start by saying the whole concept here that's enshrined in legislation is long-term debt, and debt, which basically means bonds, creditors, investors, that the whole concept. And also in the concept is that a systemic bank keeps operating. In order to keep operating, it needs to attract and retain its deposits. So even in concept in the legislation, deposits figure prominently in the ability for the bank to continue operating. Given it wasn't contemplated, deposits were not contemplated in this regime, they will be prescribed, or what's bail-inable will be described in legislation. That can change over time in the nature of what long-term debt securities are, the length of time, the type of bonds, but clearly the intent was that can change, and it will be a Governor and Council decision. It will be promulgation of regulations, and we will have to consult with the whole industry as well as Canadians on that, on the regulations. That is the natural Treasury Board process. But again, deposits aren't even contemplated anywhere in this regime. I can assure you of that.
No, should I?
We're going to have to stop it there. We will have to ask the witnesses, and we'll have to figure out a time. The witness, thank you for coming, by the way. Sorry we didn't get to you, but we'll have to come back to Division 5, Division 9, Division 12, and Division 14. And thank you for your appearance today. Meeting adjourned.